why 90% of new investors fail, so you don't.
This video is going to ensure you don't do the same stupid stuff, and I'll explain mistake number 1 straight away. Let's say you're saving for something big within the next couple of years, a house deposit, tuition, whatever, and you're thinking, maybe I'll invest to boost my balance. Something low risk, right? The big names, Microsoft, Nvidia, Apple. They're the 3 largest US companies right now. They seem like safe bets. I own 2 of those. But let's look at the last 12 months. If you bought Microsoft here, 9 months later, you'd be down 24%. You'd only be up 2% now. Nvidia here, you're down.
Hang on.
You'd be down 24%. You'd only be up 2%.
Okay. This is one of those examples of why you buy stocks as they're crashing up versus stocks as they're crashing down. And this is Microsoft. Microsoft is a good stock, right? No. All stocks are bad. All stocks are bad, but every once in a while they act right. Perfect example here. All stocks are bad. Microsoft not acting good at all. Then it starts acting right. You, as a market participant, get to choose when you buy your stocks. Nobody can stop you from that. You get to choose this. You can see right here when it was acting right. When it was acting right, you just got back to break even over the course of a year. Over the course of a year. And I've seen some people trying to talk some real trash about me on AMD because AMD is actually performing right now. Okay. But let's go back. When's the last time AMD was at this price? When was it at this price last? November. If you buy AMD in November, you've had losses the whole way down until June. How many months? That's like an infinity amount of months. Like, look at the number of candles that you just went through here, right? How many nights of sleep did you lose because, man, I made such a bad choice on AMD. I'm just now back to break even since no freaking November. Okay. Now, when you use the trend template, the 10, okay, we'll do it on this side. The 10 over the 20, price over the 50, it makes life so much easier. Listen, there are times you might make a buck or lose a buck because that did happen right here. You might have made a buck or lost a buck. But on this side, the same thing happened and what's gone on since then, right? It's up like 50% or something crazy like that. But this whole way down, I was telling everybody, stop buying AMD. Stop it. Don't do it. I don't know why I had this red circle over here. But then when it crossed over green, your 10 over 20, price over 50, and it's gone up like this, buy stocks as they're crashing up, not as they're crashing down. And don't tell me, oh, I'm going to average down the whole way. Bro, if you're averaging down the whole way, you're adding loser to loser to loser, and you do not know when it's going to come back up. And here's the deal. If you averaged at the same price on the way up, here's the thing. If you bought the same number of stocks here, here, and here, as you did here, here, and here, and here, you have the same average price. I know it's hard to conceptualize, but if you averaged your price up, you have the same price as if you would have if you averaged your price down. The difference is you bought it as it's crashing up versus buying it as you're crashing down, and you're into profitability that much faster. Look at this. In Kari, I've done that, and because of your advice, I'm up over 100 days and not blown up my account. Yeah. This is real. Okay. So to this point here, even a great stock, quote, great stock like Microsoft is a bad stock, but only every once in a while does it act right.
% now. Nvidia here, you're down 35% within 5 months and still down 3% today. Apple here, you're down 33% after 4 months and you're still down 22% today. In the stock market, short term, there are no safe bets. If your financial goal has a deadline within the next year or two, the stock market is probably not for you. Honestly, and I'll lose some views for saying this, you'd be better served stopping this video right now. Go watch someone like Graham Stephan.
Hang on. I want to be 100% sure of what he said.
There are no safe bets. If your financial...
First off, there are no safe bets is exactly what I say. All stocks are bad, but every once in a while they act right.
Goal has a deadline within the next year or two, the stock market is probably not for you.
Centurion Investing came here just for the DuckTales mug. Well, in that case, let's make it more bigger so you can see it. I completely disagree in this case. If you need to financial goal. I mean, what does he mean by financial goals, right? Without context, I'm not 100% sure what he means by if your financial goals, you shouldn't be investing in the stock market. My goal is to have more money in my account today than I did yesterday. Some days that doesn't work out. Some days it does, right? That's my goal. I don't know what he means by goals. But I certainly wouldn't take going into the stock market at long periods of time at face value, because he just proved that in Microsoft, right? Now, granted, he's only got 8,000 subscribers. And listen, I'm not quite at 30,000 yet, so I'm not trying to pull the my channel's bigger than yours. But this is not a banana measuring contest. This is I'm really hoping this is great information coming from a small channel. That's what I'm hoping for here.
Honestly, and I'll lose some views for saying this, you'd be better served stopping this video right now. Go watch someone like Graham Stephan. Cut your spending, get an extra weekend warehouse job, sell some stuff on eBay. That's all guaranteed income. The stock market isn't. But if you're playing the long game, where short-term drops don't destroy your life plans, then perfect. This video is for you. So let's get into mistake number 2. The gains you see from certain stocks can look very appealing. Robinhood, SoFi, Palantir, they're all up over 100% just in the last 12 months. Sounds great, right? But let's zoom out. In the 12 months up to the 9th of June, 64 stocks out of the US's top 500 achieved 50% gains or more. Not bad, right? I don't think so. It's just over 12% of stocks. So with some diligent research, you just might be able to find one of those opportunities. It's totally possible. But you don't really just buy one stock. You create a portfolio, don't you? So what happens then? Well, let's be generous and say, because of your diligent research, the odds of you picking a stock that achieves 50% or more gains in a year is 1 in 3, which would probably make you one of the world's best investors.
Dude, no joke. If you could do that, you're amazing. You are absolutely tremendous. Okay.
But let's ignore that for now. Even with all that stacked in your favor, the chances of you picking 5 stocks to fill your portfolio, which all beat 50% gains over the year, would be 0.39%. That's significantly worse odds than you can get for South Korea winning the next World Cup. This isn't to kill your enthusiasm. You can find great stocks even as a beginner, but you've got to stay realistic. Not every stock you pick will win big.
Yeah, there you go. Okay, I agree with this completely. This goes back to my trading psychology, right? You shouldn't have expectations on the outcome of any trade at all. Why set expectations? Because that is going to make you create a behavioral imbalance, if you want to think about it that way, where you are emotionally tied to the outcome happening. For example, you've got 2 teams playing for the championship in your sport, right? Whatever your sport is, World Series, NBA Finals, Super Bowl, World Cup, whatever. You are behaviorally tied to the outcome of that game. If my team wins, then I'm going to be so happy. If my team loses, I'm going to be devastated. You have an emotional connection to that outcome. You can't treat stocks like that. You cannot treat stocks as if it's your favorite team, right? A lot of people get freaking hosed over because they cannot set aside the expectations on the outcome of the trade. You've got to just follow your plan and exit when one of your exit signals happen, and don't do anything in the meantime. And don't get all hot and bothered and excited if it does or does not work out. You just have to follow your plan.
Expecting 40, 50, 60% portfolio returns every year, that's not a strategy. That's a fantasy. Aim to beat the market and then just treat anything above that as a bonus. And also, when you get started, you open up your Trading 212 account or whatever you use, you deposit some cash, just take a deep breath and slow down. You don't need to create a fully fledged portfolio on day one. In fact,
You mean sit in cash and don't F up, right? If you're an outlier and you've watched this before, if you've heard me say this before, type hashtag sit in. I always mess this up too. Hashtag sit in cash and don't F up. There we go. And this is real, right? Just because you have money in your account, as my dad would say, burning a hole in your pocket doesn't mean that you need to do anything. Sit in cash and don't F up is a real strategy. Okay.
Shouldn't. If you do, you'll probably not be buying the stocks at the best times, or even more likely, you're just not buying the right stocks. Take your time, find the businesses you like, and then invest in them when they're trading at a fair or ideally a low price. But what do I do with my
I don't know about that, but I would say invest in them, trade them when they fit your criteria, don't get construed. Don't get construed. Don't get construed or construed. Because, for example, at every one of these points over here, AMD was, quote, a low price, right? Because let's zoom out slightly. Let's zoom out slightly. Every one of these points was less than $200. In fact, it went to 150, 140, 130, 120, 117, 110, 100, 80, and then it hit a low of 77. Every one of these was the low price. And every one of these has been revisited on its way back up. So why would you be buying it as it's crashing down when you have the opportunity to profit that much faster if you buy it as it's crashing up? Eesh. Honestly, when people say buy low, say sell high, they don't understand. I know you're gonna be like, well, duh, that's how you're supposed to do it, right? No, 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 no. It's buy high, sell higher. But Chris, what do you mean buy high, sell higher? Of course you can't buy there. You cannot make money when you buy high and sell higher. When you're trending in a market like this is a perfect representation, right? This is buying high and selling higher. This is buying low and hoping things turn around. Hope is not a strategy, okay? Hope is not a strategy as you're going all the way down because you don't know where this bottom is. It's easy to see it now, but I'm telling you, when people were buying it in December at 123, they were hoping something good would happen. Those same people in February, when it was down at 109, were hoping something really good happened soon. Those same people in April, when it was down at $79, were really hoping for something good to happen. They didn't know where low was because low can go to zero. But then when it's going up and it's trending higher with the 10 over 20 price over 50, that's you're buying high. And it feels weird. It feels uncomfortable to buy high, but you're only going to get paid as it goes higher. You're not going to get paid as it's going down lower. Hopium is not a strategy. Hope is not a plan, for sure. Science is cool and definitely for us.
My money in the meantime, I hear you ask. Well, it's quite simple, actually. Just put it in an index fund. I have a chunk of my portfolio in the Nasdaq 100, but you can go even lower risk and put it in the S&P 500 or even a global index. That way, you're still involved in the market. You don't get that FOMO that comes when you're just holding cash. And you can take your time to spot the right investments at the right time, sell your index fund, buy the stock, and build up a portfolio that you're truly confident in. Don't frantically buy loads of stocks on day one. And if you want to feel confident in your investments, you need to avoid this very common next mistake. Diversification is one of the buzzwords in investing. Pick a wide range of stocks across a wide range of industries and lower your risk. That's great advice if you're a pension fund manager, but for individual investors, there's not so much. Let's actually take a look at a portfolio of 20 stocks.
Okay, cool. I was hoping I didn't have to disagree with him on that because you actually want the concentration. When you find a stock that's working for you, right? Wouldn't you rather be into a stock that's working like KKR is right now with big size? Wouldn't you rather be in something that is working with big size instead of saying, well, I need to have at least 20 stocks in my portfolio, so I only have 5% in any one of them. So I have to trade this a lot smaller. Or do you focus in, laser focus, figure out what's going to work for you, and then go in with size so you can have those concentrated gains? Right? And if it doesn't work, it doesn't work. You just get out.
Just looking at that is overwhelming, isn't it? Good luck tracking all of those businesses properly.
Really good point. I'm 100%, as of the time of this recording, I'm 100% in the market right now, and I have 7 stocks. Most of them are between 11 and 20% of my portfolio.
But more importantly, once you get down to your 18th, 19th, 20th best idea, are they really going to be good ideas anymore? Or are you now just forcing stocks in to artificially hit some kind of diversification target? That kind of
This actually is super, super great point, right? Are you taking trades just to make trades, or are you taking trades because they fit your trading plan?
diversification, it doesn't protect you. It just waters down your best ideas. Instead, focus on a handful of individual stocks, companies you know, companies you love, and companies you're confident in. Keep it less than 10. In your first year, 5 or 6 is plenty. And if you're worried about risk, which is totally fair enough, keep a chunk of your money in an index fund. That gives you instant diversification across hundreds of stocks.
Okay, sure. Fine. You can have that one.
No effort required, and it frees you up to concentrate on finding just a few great individual investments. There's a theme building here, isn't there? Simplicity. When you're starting out, the more you simplify things so you can focus on what's really important, the more you tilt the odds in your favor. The next mistake, it does the opposite. It tilts the odds against you, and I'll prove it. In the last 12 months, up to the 11th of June, just 28% of the top 5,000 largest public US companies achieved a return above 20%. But if we shrink that down and just look at the top 500 stocks instead, 46% of those achieved a 20% return or higher. This isn't talked about enough in my view, because most books you read or most videos you watch, they focus in on those hidden gems, the small caps that 10x over time, because those are the exciting stories. But the actual reality is that the larger, better known stocks usually outperform the smaller caps. So focusing on just the top 500 stocks is another way to help tilt the odds in your favor. It helps simplify your strategy. You don't need to find hidden gems. There are loads of opportunities for massive returns in large cap stocks. It's lower risk and they're easier to research. It's a win-win. Here's another way to tilt the odds in your favor by missing this mistake, and it's also rarely talked about. In January, I sold all my Adobe shares and I bought Uber. Both are high growth, financially strong businesses. But there's another thing they have in common, which is absolutely nothing to do with their financials. I'm a customer of both of them. I've used Adobe products since 2006 with.
But that doesn't mean that it's a great company to buy, right? I have an Nvidia graphics card. Does that mean Nvidia is the best stock ever? Let's see. Oh, by God, I guess it does. I guess it does. I own a Tesla. Does that mean Tesla is the greatest stock ever? Feels like it's had better days. My wife drives a Lexus. I don't know how to find Lexus on here, so we'll just do Ford. She used to have a Ford. Good gravy. That was the worst car we ever owned. It was a Lincoln Navigator, and I swear that thing was broken at all times. And when it wasn't broken, it was about to break. It was awful. But does that mean that I want to own Ford stock? My takeaway from this video is all stocks are bad. Only every once in a while do they act right. I don't think he's come across that yet. Well, I know Lexus is the Toyota, but I can't remember like the Toyota symbol right now. Shut up, I know this.
With Photoshop CS2, and I still use them today. For almost all that time, I think they've offered best-in-class creative software. But for the first time in 19 years, I'm starting to get frustrated with that product because I don't think they're adapting quickly enough to AI. Now, it's not in the financials yet, but I'm no longer confident that they'll stay ahead. And that, combined with it being slightly overvalued, are the two reasons that I sold. The stock's down 7% since, but if they don't catch up soon, I actually think the next 5 years could be brutal for them.
We have very different perspectives here. So I'm going to try and give him some grace. If your stock is down 7%, it's telling you that it's not right. Now's not the time to be buying it. If your stock is down 7%, you've done, you've got in at the wrong time, and that's okay. Just admit that's the wrong time and move on. I could say a lot more mean things, and I have on YouTube channels that have 800,000 subscribers. I want to talk about how smart and genius they are. I don't think this guy has that same sort of bravado. So I don't want to come down hard on him. But if the stock is down like that, it's telling you now's not the time to own it.
Customer gives you direct insight into the product quality. It's an insight that no financial report can offer. I spend hours every month using Adobe tools. I know that their implementation of AI should be better. When it is, if it is, I'll reconsider the stock.
Did you hear what he said? He said something. What did he say that made me stop the video? Anybody know? What did he say that made me stop the video? Give you 5 seconds. 5, 4, 3. Yep, there it was. Salty Brad got it. It should be. I know the product. I know the service. I know that they're going to do AI, so it should be great. Should is the most dangerous word in finance, because should is then anchoring you to an outcome that may never happen. It should go up because this product is amazing. Becca says, I use Adobe. That was the most dangerous word. Yeah. Should is a dirty word. Should is a bad word when it comes to investing, because we don't know what it's going to do. But to tell the market what it should do is asking for trouble.
But until then, that industry is wide open to massive disruption. I know that not because of any Wall Street report, but because I'm a customer. Don't buy stocks whose products and services you don't use.
Okay, I'm going to have a huge flat complete disagreement on this. Now, reason being is that I worked with 5 of them. In fact, I haven't introduced myself all day. Let me introduce myself real quick. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk. Now, back to the market wizard point. One of the market wizards I worked with is Tom Basso. He's not gone yet. And he and I had that exact conversation, because when I was working with him, I was like, Tom, I just bought this stock that I'd never heard of before. He's like, yeah, that's fine. What do you mean that's fine, Tom? He's like, dude, I do that all the time. What do you mean, Tom? He's like, you don't need to know what the stock is. You really don't. I mean, all that matters is if the price is going up. If the price is trending higher and you can ride that trend, at the end of the day, that's all that matters. And don't come at me like, oh, I'm an investor, I'm not a trader. Bro, you want to get paid, don't you? You're not getting paid on the shoulds. You're not getting paid on the hope. You're only going to get paid on price. Can't say what I used to say anymore because I got a cease and desist order. But profits follow price, right? The profits you want to make as an investor or as a trader are the same profits. The only way that those profits materialize in your account, the only way that that happens is when price is going up. So to Tom Basso's point, it doesn't matter what the stock is. If it's trending higher and you can catch and ride on that trend, go for it. Ride the wave as hard as you can. But in the meantime, don't ride it all. Find something else to ride.
A huge advantage. Now, I've mentioned that Uber purchase in my other videos. It's done all right. It's up 30% in 6 months, but I don't want you to think that that's typical. It's not. There is no magic formula to buying a stock at its very lowest point and then expecting a stock to just go up from the moment you buy it. It's just not realistic, no matter what anyone says. In fact,
he's clearly not an outlier. But actually, to that point, here are the 7 stocks that I own right now. All but, well, maybe all of them are up. Is SMTC up? Yeah. Every single one of these 7 is up since I bought it. That's how it's done. Why are they up since I bought it? Well, first, of course, we bought it because we had the outlier signals. We had the OVTLYR 9. We had everything in place for us. But they're also trending higher. And here's an adage. A winning racehorse does not back up into the gate. If you have found a stock, everything is set up correctly for you, and it happens to turn around and go down, that's fine. Just get rid of it. And then you keep the other winning racehorses. You want to beat a profitability as fast as you possibly can. And to some people, that seems impossible because they're not doing it right.
in the short term, it is much better to expect a drop than expect a gain. Be a pessimist, not a fool. Let's take that Uber example. I bought here at the start of January. Within a week, the stock was down 2%. A month later, and it was down again 3%. 3 months later, and it was down again. 30% now sounds like a good figure, but a month ago I was up 40%, so 30% kind of sucks. If you have a mindset of sunshine and endless stock gains, your morale will get crushed when that stock drops, and it will drop. To give you some perspective, when the market as a whole drops 20%, that's considered a market crash. The last one in the US was about 3 years ago. But in just the last 12 months, 361 stocks from the top 500 experienced a 20% drop at least at some point. That's 72% of stocks.
So even in the top 500 stocks, 72% of them were acting bad. They're all bad, but every once in a while they act right.
For individual stocks, large drops are unavoidable. This is why it's so important to buy stocks you are confident in, not just random guesses. Because if
I agree. Only stocks you're confident in because you have a database plan to prove that you have a strategy that makes sense. That the worst case possible outcome is you're still profitable. When you've achieved that, then you can confidently trade.
these declines crush your mentality, you will make bad decisions. Expect significant drops. But Once you start picking stocks that you're naturally confident in, you'll avoid a lot of these rookie mistakes. Like this next one, thinking that timing the market is important, but it's really not. So many people say that the market's too high or you should wait for the next dip. But when you're buying individual stocks, that is never, ever, ever the case. What matters is the business. Is it high quality? Is it trading at a low or fair valuation? When I bought it,
Part of me wants to rip him to shreds right now. The other part of me says, I think he's a good guy. I think he has the best interests here. But I'm gonna wrap this video because I think the deeper we go, the more I'm going to disagree. And I would like to be polite. I'd like to be polite. But I will tell you this. Your valuation is practically useless. Your valuation of a stock may put it at $50 a share. My valuation of the stock may put it at $70 a share. Do either one of our valuations matter in the market? Nope. Not in the least. Not at all. Because the market's going to do what the market's going to do. You can choose to fight the market, or you can choose to roll with the market. Let the market tell you which direction it's going. Once you start listening to what the market is saying, trading and investing gets significantly easier. But if you are trying to force your profit targets, if you're trying to force your investing strategy on the market who doesn't care about what you have to say, you're looking for trouble. You're asking for difficulties. And I'm trying to say this in the kindness of my heart to this channel and to you that's watching. You've got to let the market tell you which direction it's going, and not turn around and tell the market what it should be doing. You need to be listening to it instead. So thank you all so much for watching. If you're watching this live, we just covered 5 videos all at once. I've been doing this for over 3 hours at this point. If you're watching the replay, you got to be sure you watch the live videos. Have a fantastic day, but don't forget, if you're ready to save time, make money, and start with less risk, click one of these 2 videos. We will talk soon.